Welcome to the introduction of the trickle-down illusion. The term trickle-down economics evokes images of wealth cascading from the top of society to the bottom. Proponents argue that tax cuts for the wealthy and corporations stimulate economic growth. This growth, they claim, will eventually benefit everyone, even the poorest citizens. This theory has been a cornerstone of conservative economic policy for decades. However, its effectiveness remains a subject of intense debate. Trickle-down economics is based on the idea that supply creates its own demand. By reducing taxes and regulations on businesses, the theory goes, companies will invest more, create more jobs, and boost the economy. This increased economic activity will then trickle down to the rest of the population in the form of higher wages and more job opportunities. The reality, as we shall see, is far more complex. While proponents of trickle-down economics point to periods of economic growth as evidence of its success, critics argue that these gains are often concentrated at the top of the income distribution. They contend that trickle-down policies exacerbate income inequality, leading to a society where the rich get richer while the poor and middle class struggle to keep up. This essay will delve into the history, theory, and real-world impacts of trickle-down economics. We will examine its application in various countries and analyze its effects on economic growth and income inequality. By the end, we aim to provide a nuanced understanding of this controversial economic doctrine and its implications for the future of economic policy. Now, let's explore the allure of supply-side economics. The appeal of trickle-down economics lies in its simplicity. It offers a seemingly straightforward solution to complex economic problems. Cut taxes for the wealthy and businesses, and everyone will benefit. This message resonates with those who believe that government intervention in the economy is inherently inefficient, and that the private sector is the true engine of growth. Furthermore, trickle-down economics aligns with the interests of powerful groups in society. Wealthy individuals and corporations stand to gain significantly from tax cuts and deregulation. These groups often have the resources and influence to shape public policy in their favor. The theory also taps into a deep-seated belief in the power of the market to self-correct and allocate resources efficiently. Proponents argue that by reducing the role of government, the market can operate more freely and unleash the creative potential of entrepreneurs and businesses. However, this faith in the market's ability to solve all economic ills is misplaced. As we will see, markets are not perfect, and government intervention is often necessary to correct market failures, promote fairness, and ensure that the benefits of economic growth are shared broadly. Lastly, let's examine Reaganomics, a historical case study. The presidency of Ronald Reagan in the United States from 1981 to 1989 marked a turning point in the embrace of trickle-down economics. Reagan's economic policies, dubbed Reaganomics, were heavily influenced by supply-side theory. They centered on tax cuts for the wealthy, deregulation of industries, and a reduction in social welfare programs. The Economic Recovery Tax Act of 1981, a cornerstone of Reaganomics, slashed the top marginal income tax rate from 70% to 50% and reduced corporate taxes significantly. These cuts were justified on the grounds that they would incentivize investment, boost economic growth, and ultimately benefit all Americans. While the Reagan era did see a period of economic expansion, the benefits were far from evenly distributed. Income inequality soared during the 1980s, with the gap between the rich and poor widening dramatically. The wealthy reaped the lion's share of the economic gains, while the middle class stagnated and poverty rates increased. The Reagan administration also pursued deregulation in various sectors, including finance, transportation, and environmental protection. This deregulation, coupled with lax enforcement, contributed to a series of financial scandals and environmental disasters. The legacy of Reaganomics is a mixed bag. While it did usher in a period of economic growth, it also exacerbated income inequality and sowed the seeds of future financial crises. The experience of the 1980s serves as a cautionary tale about the potential consequences of unfettered trickle-down economics. Section 4. Thatcherism. Across the pond and similar tales. The embrace of trickle-down economics was not limited to the United States. In the United Kingdom, Prime Minister Margaret Thatcher, from 1979 to 1990, implemented a similar set of policies, often referred to as Thatcherism. Like Reagan, Thatcher advocated for tax cuts, deregulation, and the privatization of state-owned industries. Thatcher's policies, like Reagan's, had a profound impact on British society. They led to a decline in manufacturing, a rise in unemployment, and a widening gap between the rich and poor. While Thatcher argued that her policies were necessary to revive the British economy, critics contended that they disproportionately benefited the wealthy at the expense of the working class. The experiences of the United States and the United Kingdom under Reagan and Thatcher, respectively, highlight the common threads of trickle-down economics in practice. Both countries witnessed periods of economic growth accompanied by rising income inequality, suggesting that the benefits of this approach were far from universal. These historical examples demonstrate that the allure of trickle-down economics often overshadows its potential consequences. The promise of economic growth can be enticing, but it is essential to consider the distributional effects of such growth and whether it truly benefits all segments of society. Section 5. The legacy of trickle-down. Growing inequality. One of the most significant and enduring legacies of trickle-down economics is the rise in income inequality. As we have seen in the cases of the United States and the United Kingdom, policies aimed at stimulating economic growth through tax cuts and deregulation often exacerbate the gap between the rich and poor. This trend is not limited to a few specific countries. In many parts of the world, income inequality has been on the rise in recent decades, coinciding with the increasing influence of neoliberal economic policies, of which trickle-down economics is a key component. The widening gap between the rich and poor has far-reaching consequences. It undermines social cohesion, erodes trust in institutions, and can lead to political instability. Furthermore, high levels of income inequality can stifle economic growth by concentrating wealth in the hands of a few, who are less likely to spend it and stimulate the economy. The persistence of income inequality in the face of trickle-down policies raises serious questions about the effectiveness of this approach. If the goal is to create an economy that works for everyone, then policies that exacerbate inequality are clearly counterproductive.